Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, so let's just jump right in. We're examining the aftermath of AMD's really ambitious Yada-scale vision, the one Dr. Lisa Su laid out at CES 2026, a roadmap that promised, well, basically a revolution in AI compute.
And the market context here is just so critical. The stock closed, what was it, around $214.35, giving it a market cap of roughly $360 billion. But the telling part for me was the reaction after the keynote.
Right. Despite these huge promises, the stock slid about 3%, a really sharp, immediate dose of skepticism. And that tension, that's really where our debate begins.
Exactly.
So the question is AMD's stock a fundamentally undervalued, asymmetric growth bet, something justified by its PEG ratio, or is it critically overvalued because of execution risk and this persistent second-best discount? I'm going to argue that the evidence points strongly to it being an undervalued growth play.
And I'll be taking the opposing view, that the current valuation, that 214 price, is just far too bullish. It's priced for perfection, and I think it's exposed to failure, plagued by that structural discount, and frankly ripe for a painful contraction.
My whole position is really rooted in applying the correct valuation lens. I mean, you simply cannot judge AMD on its current PE ratio. That metric it's just deeply distorted right now. AMD is in a massive, and I'd say necessary, investment phase. They're pouring billions into R&D for the MI350, the MI400 series, scaling supply chains, building out a software ecosystem. All of these costs are temporarily suppressing their current earnings, which makes a high PE misleading. So the metric you have to look at is the PEG ratio, price earnings to growth, which actually factors in that incredible anticipated growth.
And what does that tell you?
Well, when we look at the consensus estimate of 50% year-over-year earnings growth, the PEG ratio comes out at an extremely attractive 0.70. And look, 0.70 isn't just a low number. It is the mathematical signal that the market is pricing AMD's future growth at a significant discount. Getting a PEG under 1.0 is sort of the holy grail of growth investing, and it justifies the valuation gap to its rival, especially when the Yada-scale vision itself points to a future of almost infinite compute demand. I mean, a 10,000-fold increase. The demand curve is there.
Okay, I agree the growth potential is immense. I don't think anyone disputes that. But your argument, it's anchored almost entirely in that PEG ratio. And that conveniently assumes that this growth is all going to materialize flawlessly. The immediate reality is that this stock is critically exposed to risk right now. The forward PE for 2026 sits exceptionally high, somewhere between 33 and 42 times earnings.
Right.
And crucially, that is higher than its dominant rival's forward PE, which is sitting comfortably around 25. So why should the market pay a premium for the challenger, who has way more execution risk than the established leader? The market has already priced in the entire Yada-scale vision. It's done. Now it's demanding absolute flawless execution, quarter after quarter. There is structurally no room for error. And the risk that I think bulls persistently overlook is that second-best discount. Hyperscalers, their biggest customers, they are incentivized to use AMD primarily when they can't get enough chips from the main rival. If that rival's capacity increases, which it will, the demand for AMD's chips could just dissipate. And that creates a very real risk of a classic, brutal semiconductor cycle bust. A risk that the current $214 price tag simply does not reflect.
I see why you think that. I do. You're focusing on that historical PE and taking a sort of default risk-off posture. But let's shift from the technicals to market psychology for a second. If the execution risk were really as severe as you suggest, if the big institutions truly believed AMD was critically overvalued, we would see aggressive bearish positioning. But that bearish talk just isn't backed by bearish money.
What do you mean by that?
Look at the aggregate short interest. It is exceptionally low for a stock like this. We're talking a short float of only around 2.3%. Companies that face genuine skepticism see figures well over 10, even 20%. What's more, the days to cover ratio is minimal, between 1 and 1.67 days. What that means in plain English is that shorts can cover their entire position in less than 2 days of trading. This completely eliminates the risk of a real short squeeze, and more importantly, it confirms that the major short sellers are just unwilling to take a fundamental, naked bet against this AI growth narrative. They might be hedging, sure, but they are not shorting the vision.
That's an interesting point on the low short interest, but I think you're misinterpreting the signal there. A low short float doesn't necessarily imply bullishness. It often just means the stock is cheap to borrow and it's highly liquid, which makes it perfect for quick hedging and arbitrage. The low days to coverages confirms it's a trader's stock, driven by rapid inflows and outflows, not steady conviction. You see it every day. 38 to 43% of the daily volume is consistently marked as short volume. That volatility creates a ceiling.
Okay, but
And more concerning than the short float is the signal coming straight from the C-suite. We've seen consistent insider selling from Dr. Su and her team, mostly through 10b5-1 plans, totaling over $20 million in sales. Now, yes, they're programmatic for diversification, but the narrative is a problem. Why, if the stock is truly at a 30% discount to its growth potential, are the people with the deepest insight not buying? Their actions just speak louder than their keynotes.
I agree. The lack of widespread executive buying is a nuance we have to acknowledge, definitely. But that rare $500,000 purchase by the chief commercial officer, Philip Guido, that's a critical green shoot. It shows conviction in the commercial pipeline, which is his entire domain. And that one action, it contrasts sharply with the broader institutional flow, which actually tells a powerful story of patient money accumulating.
I'm not so sure.
Well, look at the big, sophisticated, growth-oriented funds. T. Rowe Price Associates, for instance. They executed a massive accumulation, increasing their position by over 75%. They added roughly 15 million shares. That is a powerful, unambiguous signal of conviction in the 2026 to 2028 timeframe. They are betting the Yada-scale reality will yield multifold returns. When that kind of patient, smart money takes ownership, it suggests the stock's current lag is just temporary consolidation.
I come at it from a different way, though, when I look at those flows. That accumulation is being significantly offset by a heavy institutional rotation that's all about risk mitigation. It's a signal that conservative money is getting out while the getting's good. You have major players like Wellington Management Group, known for holding long-term positions, shedding a staggering 93% of their holdings. JP Morgan Chase cut their exposure by 47%. This isn't just profit-taking. This is conservative money deciding the risk-reward profile is no longer favorable at 214. They think the easy gains are over, and that high turnover is what's creating the price ceiling you're calling consolidation. The stock isn't consolidating, it's absorbing massive supply from exiting giants.
But that whole conflict is secondary to the company's strategic shift. It's a shift that fundamentally changes the competitive landscape. AMD is no longer content to just be a component supplier, selling chips for others to integrate. The introduction of the Helios rack scale system at CES, that moves AMD directly up the value chain. Historically, their rival forced hyperscalers to buy their proprietary DGX systems. With Helios, AMD directly challenges that entire vendor lock-in model. By using Open Compute Project Standards, OCP, AMD positions itself as the necessary open alternative. This appeals directly to the biggest buyers on the planet, Meta, Microsoft, Google, who absolutely despise vendor lock-in. This move structurally addresses the second-best discount by offering a superior system solution, not just a comparable chip.
I'm just not convinced by that line of reasoning, because a strategic pivot like that requires perfect execution, and AMD is chronically battling a brutal timing gap in product deployment that just negates a lot of that advantage. Let's look at the timeline. The MI350 series is positioned to compete with the rival's Blackwell architecture, which is already shipping in volume now, in early 2026.
Right.
This puts AMD constantly in a position of catching up. By the time they ramp the next generation, the MI400, the MI500, targeting 2027, their rival will likely be deploying its Rubin architecture. They are perpetually chasing a moving target. What that functionally means is that AMD has to win deals solely on price to performance. It cannot win on time to market. And even if they offer a better chip at a better price, we can't ignore the elephant in the data center, the software friction with CUDA. CUDA is the language of AI. Developers default to it, and until AMD's Open Rossi platform achieves genuine parity in tooling, in libraries, in community, that software gap remains the crucial, sticky drag on mass adoption.
But the software problem is precisely why the OCP and Helios strategy is so critical. The hyperscalers are dedicating massive engineering resources to abstract away from CUDA for the very reason that they hate vendor lock-in. They are the ones with the scale to force the ecosystem to shift toward open standards like ROCSEM. While your enterprise customer might be sticky on CUDA, the hyperscalers, the ones buying Yada-scale systems, are actively working to break free. AMD is positioning itself perfectly to capture that demand. Second best is becoming the open alternative.
But even they face timelines and budget constraints. If MI350 adoption is slow because of that timing gap, or if the MI400 slips by just a couple of months, those institutional risk-off forces we talked about, Wellington, JP Morgan, they will be proven correct for exiting. When you look at the high PE relative to the rival, the market is pricing in zero execution failure. And yet, historically, execution failure is precisely what has plagued the challenger in this industry. It's a high-wire act, and the market is not discounting the possibility of a fall.
The risk is real. I won't deny that. But I maintain the structural bull case is undeniable. The sheer size of the AI infrastructure build-out, the Yada-scale reality, means even a successful number 2 can achieve massive scale and multifold revenue growth. The low short interest confirms the risk is asymmetric to the upside. And the patient accumulation by funds like T. Rowe Price suggests the current price action is consolidation, with smart money taking advantage of the volatility. The technology is real, which makes the valuation justified by future growth, not by suppressed current earnings.
To summarize my position then, while I fully acknowledge the potential that's defined by that compelling 0.7 PEG ratio, I have to reiterate that the current PE multiples sitting between 33 and 42 times, they require absolute flawlessness. The significant institutional churn, the perpetual competitive timing gap, they all suggest the downside risk of the second best discount is far from gone at this 214 price point. The stock is, right now, a high-stakes trader's vehicle, subject to rapid technical flows, not the definitively undervalued long-term investment that the PEG ratio alone might suggest.
And I think what this all demonstrates is that investors face a critical choice today, anchored by that $214 price. They have to choose between the anchor of massive future growth potential, represented by that incredibly low PEG ratio, a mathematical invitation to bet on the future, and the undeniable uncertainty of near-term execution against a powerful monopoly. The true direction of AMD's stock, and whether it ever realizes that Yada-scale vision, it really remains locked within the silicon performance of the MI400 and, maybe more importantly, the conversion of those hyperscaler order books over the next 18 months.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.